$100,000 used to mean success. Today, it might mean nothing. Welcome to Invest Podcast, the show where top minds in investing, personal finance, and wealth building share their insights. We break down the markets, money, and the psychology behind your financial decisions, helping you make smarter choices every day. So this critique is all about the strange financial reality for high earners. We're talking people making $200,000 or more, and why so many of them are somehow still living paycheck to paycheck. What the material does really well is it nails this core tension. You know, this idea that a high income creates an illusion of affluence. And yet, the stats are pretty stark. 20% of households making over $150K are paycheck to paycheck. And that number, it jumps to 41% for those making $300,000 to $500,000.
Which is just staggering.
It is. So the piece identifies some big mistakes, but I think we can sharpen the strategic framing here to really give some actionable insights.
I agree. That central conflict is what makes it so engaging. It gets right at that feeling of shame high earners have when they look at their bank account and there's nothing to show for it.
Right.
And lifestyle creep is correctly identified as the culprit, but I think we can go a level deeper here. The material could benefit from a much sharper distinction between the psychological pressure of, let's say, high earner overhead and just purely discretionary spending.
Okay, unpack that a little.
Well, right now, the discussion kind of lumps everything together. It conflates the unavoidable rising fixed costs, what some people are calling the high overhead trap, with the more aspirational, kind of frivolous spending.
Like the $400 juicer example in the notes.
Exactly. You're putting a massive property tax bill in the same bucket as a fancy juicer.
And I can see the issue there. If you mix those two things, the necessary costs and the optional ones, the listener who feels genuinely trapped by their mortgage, which might be half their income, they could just tune out.
They'll dismiss it completely.
Yeah, because they know cutting out lattes won't fix a $5,000 monthly housing bill.
Precisely. It blurs the lines. And then the advice just sounds like basic budgeting. Just tighten your belt. And this audience, they're not here for budgeting 101. They need a more sophisticated strategy. So our suggestion is to really structure the critique to isolate that high, non-negotiable overhead first.
Validate their experience.
Yes. Show them you understand that cutting back isn't enough when their core costs are just skyrocketing. You have to frame it as a structural problem, not some kind of character flaw.
Okay, so it's not just about saving money, it's about strategically attacking that fixed cost base. What does that sound like in practice? How do we give them concrete examples?
Well, we need to explicitly categorize those expenses tied to, geography and expectation. Call it the overhead.
Right.
We're talking about the bigger mortgage that comes with being an executive in New York, the higher property taxes, pricier insurance, even the $300,000 average cost of private school for one kid.
These aren't luxuries. They're almost prerequisites for the job or the lifestyle.
They often are. And you can use that 41% stat to hammer this home. Their struggle is often about this massive fixed overhead, not just ordering too much takeout.
Okay, so once we've established that, what's the pivot?
The pivot is to what you could call discretionary creep.
The choices versus the trap?
Exactly. You say, okay, we get it. Your $15,000 a month and fixed costs is the real problem. Now, let's talk about the extra $1,500 you're spending on top of that through small optional choices.
Got it.
By separating those two, the advice shifts from just spend less to how do we restructure the fixed and then get really rigorous about the variable? It totally changes the conversation from guilt into pure strategy.
That framing of the trap versus the choice that's a crucial distinction. And speaking of strategy, I noticed the source material really emphasizes timing, especially around taxes. So a key theme seems to be this difference between proactive planning and just reactive prep.
It's definitely there, but it needs more meat on the bones. I mean, poor tax planning is correctly called out as a huge error.
Yeah.
But the material could offer much more specific high-leverage examples that are actually tailored to someone with a $200,000 plus income. The weakness is it accurately points out that people just hand a stack of papers to their CPA in February. right?
The rear view mirror thing?
Exactly, the rear view mirror event. But the suggestions for how to fix that they're a bit vague. A sophisticated listener needs concrete examples of what year-round planning actually is. Just saying consult your CPA isn't enough.
That's a fair point. For this audience, small strategic moves can have massive impacts on their tax bill. But I wonder, should we assume they know all the specific tax vehicles?
We don't have to teach them how to file a K-1, no. But the feedback should at least suggest the avenues for them to explore. It needs to signal the level of sophistication that's required here.
So more about pointing them in the right direction.
Right. The suggestion is to focus on that strategic difference, preparation versus planning. Planning is about forecasting the entire year ahead.
Okay, let's make that actionable then. So instead of W-2 deductions, what kind of things should they be looking into?
We should suggest they research specific structures that can reduce liability, things outside the typical box.
Like what?
Well, depending on their situation, maybe exploring complex trusts or retirement structures that are specific to people with non-W-2 income. These things require time and modeling. They are absolutely not tax day decisions.
And it's the timing of the conversation that matters.
That's the crucial part. They need to consult professionals not just during tax season, but around major liquidity events.
So when a big bonus is coming, or when a bunch of stock is about to vest.
Exactly. Lewis Rose's point in the notes was perfect on this. You have to capitalize on strategies that look at the road ahead, not just the history you're about to submit.
Yeah, that rear view mirror versus road ahead framing it's perfect. It immediately flags the behavioral mistake, which is treating taxes like an admin task, not a strategic exercise. Okay, let's pivot to the psychological side of this. What I really loved in this section was the counterintuitive idea that you can actually save too much. That it's a mistake to be paranoid about not having enough. This ties right back into that initial false confidence high income can give you.
That is by far the most fascinating part of the material. And it's such a powerful point, but it needs to be integrated much more strongly with the goal-setting section.
Right.
So you can help the listener realign their capital with, their immediate quality of life goals. Because right now, this idea that high earners are robbing their future self of a wedding, a renovation, or that dream vacation, it's kind of presented in isolation.
And I think isolating it creates a real problem. Because if you're always scared you don't have enough, you just keep shoving money into the deepest, most inaccessible buckets you can find.
Yeah, that anxiety just overrides everything else.
It does. It's like, why spend $50,000 on a down payment when I could max out my 401k? And that's the psychological friction we have to solve for them.
Precisely. The core weakness is there's no structured advice that links that misplaced savings fear to the need to set clear intermediate financial goals. They're saving defensively, not offensively.
So what's the suggestion?
We need to frame that aggressive, misdirected retirement saving as a symptom of a deeper problem. And that problem is not defining and funding clear short to medium-term goals.
So we're essentially pushing them toward an intentional segmentation of their capital. But how does that solve the guilt they feel when they actually spend money on something?
Well, that intentional segmentation is the key. You encourage them to pre-allocate capital, so when the money is already marked for the trip or the renovation,
It has a job.
it has a job. And that allocation has been modeled so it doesn't hurt their retirement. Suddenly, there's no guilt. The money was always for that purpose.
Okay, so concrete steps for them.
We need to draw a direct line between that lack of clear goals, the clients with $300,000 incomes who have nothing to show for it, and the paranoia that drives the oversaving.
So instead of just blindly dumping cash into an IRA, they need to define specific life goals that need liquid cash.
Exactly. Define the down payment goal, the sabbatical goal. Then assign target savings rates to those goals outside of their tax-advantaged accounts. It's not just about saving, it's about making their spending intentional. And this is where we need to emphasize Milani's advice from the notes. When you know your numbers, you stop feeling guilty. And knowing your numbers means defining those specific non-retirement accounts that are meant for enjoyment. That turns saving from a defensive move into an offensive strategy for actually living your life.
That's incredibly insightful.
It validates their drive to save, but it corrects the location of that saving based on their actual life goals.
Right.
Okay, so we've covered a lot of ground here, moving the analysis from general advice to much more sophisticated strategic planning for this specific audience.
Absolutely. I think the material is already strong, but these three structural shifts will really maximize its impact. So just to recap. First, recategorize lifestyle creep. Sharply distinguish between that unavoidable high overhead and the discretionary spending.
The trap versus the choice.
Exactly. Second, deepen the actionable advice on tax planning. Focus on year-round strategic moves, especially around big liquidity events.
The road ahead, not the rearview mirror.
And third, integrate that over-savings paradox directly with goal setting. Use it to fight savings paranoia and enable intentional, guilt-free spending.
Excellent. We highly recommend taking these suggestions to strengthen the narrative structure and the actionability of your financial advice. And of course, feel free to submit your updated material back in for another critique. If this helped you see money differently, don't stop here. Subscribe to the channel because staying static is the fastest way to fall behind.